I'm Rob Sarney, and you're listening to What the Heck Fintech, where you'll experience and learn that Fintech is Fin Life. Let's get started. Welcome, everybody. We got a great episode for you today. We have Mike Nugent. He's been in Fintech for so long. He's done so much, and currently right now co-founder of BPS Ventures, yep, and was general partner at Vestigo Ventures. And I know you're coaching and helping and on the board of like so many Fintech startups too. So your career and what you've done to date, and you're going to keep going, obviously, it has been unbelievable. We're all going to learn so much from Mike, and it's just going to be great learning from all of us. And I want you to give a little player profile, a little background of it. I won't do it justice. And I haven't done this for any other guest. And I'm going to let you can start your story when you were in the crib. Because I know that when you were in the crib, you were looking up and counting whatever was floating around you right then and there. You go, there's got to be a frictionless way to count that better. It's moving on me. You must have thought that right when you were in the crib. You know,
definitely. I was a fintech prodigy in the in nursery school.
I think in the crib. I think early you were thinking there's got to be a better way. I'm counting this and it keeps moving on me. I got to get it. I make it a frictionless, right? So,
I wish that was true, but Rod, thank you for the very kind introduction. I appreciate it. Definitely took a little liberty in the positives there, but anyway, so. Mike Nugent, co-founder, general partner of BPS Ventures. Prior, was managing director with Vestigo Ventures, and before that, I was a fintech founder. Excuse me. So, I started my career, back in financial services. So I was originally in the public markets. Started at Merrill Lynch, Prudential Securities, NASDAQ. And the great thing was that I had all this exposure to, fundamental analysis and every different type of asset class and all the stuff that went into it. But what I realized is I didn't want to work with companies when they were worth, $300 million or $3 billion. I wanted to find them when they were like 3 million or 10 million. And that really was the catalyst for me to move from the public markets to the private markets. So when I was at, NASDAQ, I was living down in Washington, D.C. I had started my MBA at American University. And I had this amazing accounting professor who said, you need to go to school where you want to be. And, I told him how much I love Boston. He said, well, don't tell anybody, I'd get in trouble for this, but I'll write you a recommendation to BC. I used to teach there, and it was just, absolutely, serendipitous. And, so had a chance to move back to Boston because I wanted to be here. Got into BC and just, leaned in as much as I could, and this is, 99 through 2001. So sort of the height, the dot-com bubble. And had a great internship with a private equity fund of funds, and also had been working on a trading desk for one of the big banks up here. And I just, had it in my head. I wanted to get to this earlier stage. Where are these companies being born? What are they doing? Unfortunately, the dot-com bust happened, right around the time that I was, completing my MBA at BC. Landed a wonderful position with a private equity fund of funds up here in Boston by the name of HarbourVest. And really loved working with the venture capital funds. And, it shifted then from, public markets to private markets. And I'd say the thing that stuck out to me at that time, just how do you have, so much money, in these private market commitments that are locked up for 10 years with so little data, so little information, so little analytics, and everything was being run on spreadsheets and, largely your Rolodex for anybody that remembers what that is. What are the contacts? Who do you get in touch with? And so after about 10 years in the private markets on the asset allocator side, I left and I founded Bison. And Bison was really inspired by Morningstar and FactSet. And, Morningstar on the data, FactSet on the analytics, but really addressing the private markets. And, it was pretty funny going from, operator, analyst, to actually having to build something. And, when you're on the outside looking in, it's really easy to say like how things should be done or what you think is the right way to do it. to then you actually have to go out and do it. And, I know one of the things that, everyone likes to talk about is, what's the biggest mistake fintechs make or, it's they go out and pitch and they don't go out and listen. And that's one of the things I had to learn the hard way. I had an idea as to how we could address some of the problems that I saw in private equity, particularly asset allocation. I went out and pitched an idea and, it was sort of lightning in a bottle, but it was a faulty bottle. We had really strong interest for a marketplace where people wanted to lean in, buy side and sell side. But what I found out, shortly after, maybe a quarter into it, we had a quote unquote $10 billion marketplace between buy side and sell side interest, that there was a signaling risk. And what we were going to wind up doing was attracting sort of the lowest of the low of the, investment managers, because they wanted to use a platform that they didn't have to look people eye to eye, and they could just hopefully raise money, and didn't want to support that. And, we understood that you can really build a marketplace in one of two ways, either through inventory or content. And, we went the inventory route. That's what we were doing in this initial pitch. We pulled up the handbrake and moved to the content side and realized what are the greatest providers out there, in FactSet and Morningstar. And that's what we wanted to really build for the private market. So ran that for about 6 years, brought in a wonderful, third-party partner as an investor that had just, offices everywhere and tons of experience. And, for me, it was a great time to be able to get back to the early stage, where I could go back and help fintech founders not make the same mistakes I made. So joined Vestigo Ventures, was there for almost 7 years. And then, left, and really with the idea of really tripling down on the early stage and really addressing the hands-on help that, I want to give to founders from what are those typical shortcomings we see in the earliest stage of fintech companies. So hopefully that's a good background.
Wow, that is awesome. What a story. And I'd like to go actually a little bit back to the beginning, not to the crib like I started.
Sure. Yeah.
Let's talk a little bit about NASDAQ, because
Yep.
I mean, that was, what do you say, in the early 90s that you did NASDAQ? Was that like late 80s?
Yeah, late 90s. But it was, 98, 99, that time frame was just wild. Every company that had a .com associated with it seemingly could get, public and trade and go up just some staggering amount in value. Where I was, we were originally on K Street in Washington, D.C. The whole team moved out to Gaithersburg, Maryland. Wasn't exactly what I was looking for as a kid moving from Boston down to D.C., but hey, it was a great group to work with. And what you really learn is just like how far and wide all these companies are. And particularly after a short period of time of working with a number of small cap companies, I moved up to the national market to work with all the non-US issuers. So every foreign company that had a company listed on the NASDAQ stock exchange, or NASDAQ stock market, excuse me, are the ones that I was working with. And it was just such a cool, exciting thing to do, because you could have a massive insurance company in Japan that is buttoned up and filing all their filings and getting in touch with you, and, completely, open communication and just great. And you could have some dodgy online gaming company out of, the streets of Gibraltar that were then in South America. And they were like seemingly always running away from, some sort of, financial regulator. So just to see the range of companies, and then, all the little trends you could pick up on, at the time, Radware out of Germany had so many companies spin out of it. It was just out of Israel, not Germany, excuse me. And all of those companies went on to just be so successful. And for me, it was funny enough, I can't chime the bell and say that I was one of those guys that, got the .com era. I remember, I wound up investing in, one of the .com stocks that a buddy of mine that worked there with me was like, oh, you really should take a look. It's going to move. And I'm used to the public markets at, Merrill and NASDAQ and, Prudential Securities, where a 12 to 14% annual return is a really good outcome. And I'm like, wow, okay. And one of the stocks, I bought in at like $10 a share, and at the end of the week, it was at 17. And I just panicked. I'm like, whoa, this is crazy. Something's wrong here. It's overtraded. I've got to get out. I'm sure that stock went on to be super valuable, and I could have retired years ago had I stuck with it. But it was just beyond my concept of, this quick trading, quick moving, big jumps in valuation. But, it really did reinforce my drive to want to get to these companies when they were nascent and not when they were public. And you got to see who were all these shareholders, who were all these major VCs that had been backing them, and they were able to sell down in the IPO on the secondaries. So it was probably one of the most informative experiences I could have had. And I'd recommend it to anybody. If you can get to work at an exchange, at a market, you really do get to see every angle of these companies, from the basic finance that they need to provide, the regulatory bodies, what those industries and sectors are doing, how are they trending, what's the trading. When you think about it, it just encompasses everything you'd want to be able to get your head around if you're interested in financial services and particularly financial technology.
Wow. Now back then in the 90s, was it just starting to get heavy data driven analysis, or was it just starting, or was it very deep? Because I'm a product of the 80s, right? And just
Right.
it was all so manual back then,
Right.
and no one really had access. 90s, because of the internet, started picking up a little bit, right? So data was getting a lot more focus. But now it's like crazy about the data. But you saw early on when it was just starting to really, right before the internet boom, right? What was that like? And when you first was it? And if it was very technical, I remember, I just went on the New York Stock Exchange like 3 years ago for my first time in my life, right? Just to see the opening bell, and I was like, "This is crazy," right? And I know that I used to see the old movies and stuff where it was all people, talking, yelling on the phone,
waving papers, yelling at each other. Yeah.
It would waving paper, right?
Yep.
So what was it like? Let's give us back. So for younger folks, what was it like back in the 90s? Because they already seen, you don't see a lot of that trading in the 90s setting. You see a lot in the 80s, maybe because I watch a lot of 80s movies. But what do you think?
So the really interesting dynamic, is in the mid 90s into sort of the late 90s, and this is a run up to the .com era. That was sort of the first wave of day traders. So you had all these people that were able to get information much more easily than they did, a decade before. Recent college grads that could jump on to an account, they were able to get sort of, low cost trading price, and they had enough information to be dangerous. Now, some of those people turned it into professional careers. A lot of people were just day traders that, might have had a good run, might not have had a good run. But I remember, that was the first thing that really kind of stood out to me for this is a data-rich environment, finally, where you don't have to be, an employee of Merrill Lynch, Morgan Stanley, UBS to get the information that you want to feel like you can make an assessment, you can get a buy price, you can get a targeted sell price, you could balance everything out, you could, sort of have a good enough idea that you feel confident to put money into something. This was the dawn of the first accessible information and low cost trading that you had the first day trade boom. And a lot of them did jump in and take advantage of all of those IPOs that were happening, at that time. And, when you look at every one of those .com era IPOs, not many of them survived, but the ones that did are just staggering. I mean, look at Amazon. Amazon is a product of that environment. But, Bezos and the team there, they continue to grow and grow and grow and grow. And it's now, one of the most valuable companies and biggest companies in the world. But a lot of them weren't, like Pets.com and, some of the other, goofy ones that were out there. But people were able to sort of day trade and, they didn't necessarily have traditional fundamental value, but they could use technical trading analysis, so there was more and more available and more tools are being created for folks to be able to go ahead and do so. And I'd say from the regulatory side, that's one thing where I'd say the data has always been very rich, because you're getting all the filings from, you should be getting all the filings from the companies. You don't always get them. And then you have access to LexisNexis and all the database, whatever you want to reach into. So from the marketplaces, from the regulators, and that's one thing that's interesting about, NASDAQ, it's sort of a quasi-government entity that acts as a bit of a regulator and a bit of a marketplace together in everything that it does. So to be there, you had a ton of information. And I'm sure you remember back in the days, the old bridge systems where you could see all the bids and asks and how many far everybody was away. We all had access to that. So we could see sort of the anomalies that were going on. And that was, right up there with any one of the traders, anyone that was like really moving institutional capital. We had to see that to make sure we were staying on top, but we also had the ability to contact the companies and request the additional information beyond what they were actually submitting to us. So it really does feel like it was sort of the dawn of like the data rich environment for financial services without the dependency on being a major wirehouse and what their proprietary, equity analysts and bond analysts were saying.
Yeah. Wow. Thank you. That's great to hear that perspective. I'd like you to do a little compare and contrast to like, what do you see today from a data standpoint and an analysis standpoint, and what you do today, and what and how it was when you first started out? But then also, I'd love to hear, because information and learning about this stuff is happening so fast in the fintech space and all the financial spaces. Even the startups, how they transition and how they act and behave and talk about things compared to when you first started out to what you see today when you're talking to a startup. I know it's a multi-part question, but
yeah,
a little compare and contrast on both those fronts would be the data and the people side of that.
Yeah. And I'd say even take that up maybe one level higher in there is just like the general startup then versus now, because it does sort of encompass all that. But, back in the day when, I thought I wanted to like go into venture capital and get out of the public markets. Sorry, my dog Jake just decided to join the podcast. So, if you go back and look at the way that deals were done back then, Series A was the sort of original round to get a company going. Series A might be the third, fourth, fifth round of financing now for a lot of these companies. Typically you might have had maybe a friends and family, angel round that people did back in the day just to get a little bit of, money in the bank and sort of like, a light proof testing and be able to go out and speak to VCs. But then they would go raise a Series A. Series A's might have been, a $10 million Series A round on a concept. And then they would, sort of prove or disprove whether or not the investors liked the idea. They'd get the money and they would go into this sort of stealth mode, like 12 months, they'd disappear, they'd assemble the team, they'd build stuff. And then they'd pop up 12 months, 15 months later, and they'd have their, out of stealth mode. And here's our wonderful new toy. And what they would find out at that time is maybe 15 to 50% of it was what the market wanted. And 50 to say 85% of it was sort of, throw it to the wayside. Let's double down on what the good parts are. But the cost of computation, the cost of like storage, data, access, everything was so much higher back then. But it was also just a much more inefficient way of building companies. Fast forward to, say, 2015, it's when you start to see the advent of like the low cost of cloud computing coming in, right? Just sort of scratching the surface with Amazon Web Service and, everything else that was going on. And now you could actually start to build things much more cost effectively. You can actually test things. You can have more branches. And what really came of that sort of, 15-year change was just the development of these early stage tools, this like really getting into customer development. And that's what I had to learn firsthand. When I left SVG Capital to found Bison, I went out with an idea that I had, spoken to some, friendlies about and went and pitched it. And the problem with pitching is you turn off the audience's mind to be open and questioning and providing their, unfiltered ideas to you. They're just listening to what you're pitching them. And so what it does, it probably closes off 90% of what they should be sharing with you. But if you go out and ask questions, now it's an open field. Now you can find what really is of importance to the market. And then you can do this in just much quicker, more cost-effective iterations. And so now instead of needing $10 million to go into stealth and pop up and hopefully having something valuable, now you can do this on a couple $100,000 with some folks in part-time, and you can go ahead and test and make sure people are, like seeing your MVP and saying, I can get behind that. So just the capital efficiency in the market is wild. And even just the number of, technical, folks has just ballooned. We're in a bit of a weird time right now where you're seeing a lot of, recent computer science graduates are saying they're having a tough time getting hired as a result of the advancements in AI, but also questions about the economy. But we're going to need, computer science engineers. I mean, there's no doubt about it. And we're going to always need them. This might just be a blip in the economic cycle that's, adversely affecting them. But there's so many more today than there was in 2000. And that's another good thing. You weren't scraping to find one or two people that could help you or put 5 hours aside a week. So now you've got a ready pool of highly skilled professionals that can jump in, whether they're fresh out of college or 30 years veteran, to help build stuff. And then you've got low cost of computing. You've got data everywhere that you can kind of lean in on. You can find out about competitors or prospective partners. I mean, just think how hard it was back in the day when people were going through like old D&B books to try and find information, or now it's like, oh, I can type this in and ChatGPT can tell me who I should be partnering with. Like, that's mind blowing. So the entire environment, the capital efficiency, the low cost of being able to build, the readily available teams, and the free flow of monies, from venture and a lot of the new entrants into venture stage companies is just astoundingly, a stark contrast to what it had been.
Yeah, I mean, it's come a long way. I mean, I was at Fidelity. I started there in 96 and I left in 2019. And I saw a lot of change happen in the market and what they do and how they look at it, and then computing power and cloud and no cloud, then cloud, and all that stuff is very interesting. And things are just moving so fast these days. And it felt fast back then. It's even faster now. It's just crazy, right?
Yeah,
wow.
It's a quickening.
Yeah, it is. It's the cycles, everything needs, because the world and the information flow is so fast now. You have to be on top of things, and you have to pivot quickly. You get to fail fast, which is nice, and then you can pivot quickly, and then and understand more. Now wait until you, have that big deliverable. It's all about delivering small stuff.
And all that A/B testing and actually being able to listen and learn. And I think that's one of the most important things is, coachability and the willingness to learn, because far too many companies fail because of how rigid and how righteous, some founders may be. I know this is the right thing. Well, if the market doesn't agree with you, you're going to be wrong. And too many founders think they're smarter than the market. The most important thing you can do is learn. Learn what the market wants, learn what the market's willing to pay, learn the right path to get there, learn the language of the market you're pursuing. Because if you don't, you're going to absolutely miss the mark. And if it's a point of pride thing, what's the thing you could be most proud of? It's, to learn and be successful, not to like hold yourself out that I had the right idea. The market just didn't get it.
Yep. Yeah, I mean, those elements that you just brought up of the founders pitching to you, and you're hearing of them. You've seen so many, and you've coached and mentored so many. I was going to ask you a question about that, and you just answered a bunch of it with the coachability, the be able to listen, and because there's some, and I had that simplistic approach when I would hire at Fidelity for my team for IT, and I would if they're not coachable, I don't want a prima donna that's not going to listen to their customers, their internal customers, their peers, because everyone can't know everything. They have to learn from each other, and that's what makes a great team. That's how great championship teams get done in sports and also at work, right? So in the coachability, if you're not coachable, then I don't want you on my team.
Right. Yeah. Very, very simple.
what other elements do you look for when you see a pitch? You can almost see, right? Even when they probably walk in the door, and you can counter this, whatever you say too, is like when you know, they have it or they don't have it. But
Right.
have there been times too where you thought they had it or didn't have it, and they proved you wrong 2 months down the road or 5
Yeah.
months down the road? Because you always don't read people 100% correct
Right.
all the time.
Yep.
But sometimes you do. What are the things that you just gave the coachability, the listening? What other elements do you look at? And that's great. You're giving great coaching when you answer this question to younger folks that are thinking about doing a startup.
So I would say that there's a couple things that, that we definitely look at, and, have historically proven to be very beneficial when assessing founders. One is not just the coachability, but it's two, how do they treat others? And that's something that's sort of very easy to see. If you're meeting somebody for coffee, do they act like a jerk to the barista or the person at the counter at Dunkin's, right? Or are they good, kind, friendly, polite? Thank you, please. Yes. I mean, like, that's really simple stuff you can do.
Yes.
And it's just a clear indication of what the culture could ultimately be like, as you build an organization. And, one of the things to remember with these teams, right? So say you have a large company and you've been successful and you've got 1,000 employees. If you add 333 employees, that's a staggering change. Well, that's kind of what happens when you go from, a team of 2 or 3 and you add 1. It's a completely different dynamic. And so you have to understand, like, how does this all work? How do people treat each other? Do they respect each other? Do they treat each other well? So I think that's a very important piece to it's a little bit of a litmus test. It's probably less scientific than a lot of the personality profiles that some people lean in on. But it's just, how are people? Are they a good person? Are they not a good person? That really resonates. It really resonates, at least with us, and I'm sure there's a lot of other people that feel that same way. The other thing too is really to think about what is your script? And by that, I mean, like, are you speaking a language people will understand? Because all too often founders come in, and founders are definitely the matter experts in the room, right? VCs are maybe sector experts, but they're not going to be the absolute matter expert on something that you're so wildly excited about. You're going to build a company around it. But when you come in, you can't be loaded with lingo and jargon and, obfuscation of what you're saying. Like, you need to be crisp, clear. And, we always joke, it's what, like, you need to explain it like you're talking to a 5th grader. So even though these VCs could be incredibly bright people and successful and have more invest, they probably don't know the exact, execution platform for commodity hedging that you're referring to. So don't make those assumptions, or, like make sure you get down to, good, clean, simple language. And I, one of the things that I loved, and it was one of my mentors gave me this guidance when I was first getting Bison going. He's like, can you explain your company so your mom would understand? And I was like, oh God, no. And that was one of the things where I had to, like, sit down, pull myself back, and just make sure, like, okay, like, I can explain this to the average person now. This is much more consumable. This isn't me assuming someone knows about cap calls, distributions, FERPTA, all that stuff that gets into such, sort of unique nature, even within a fairly large industry. People forget about it. They lose the forest for the trees by just getting into their own jargon, lingo, expertise. So you need to be able to explain it like you can to somebody that, doesn't come from your exact experience. And then the other thing I'd say too is you got to do some homework, right? When you do go speak to somebody and they are a matter expert in the space that you're referring to, make sure you don't forget to do a little bit of homework and know about the players in the space. Because if you don't know, and it was funny, we were at a large Fintech class and competition in Cambridge, and one of the companies that was presenting, that was a finalist, was doing something in private equity markets. And, they definitely, and my name was out there as one of the judges and my background and, the whole bio. And these guys came up and they pitched, and I asked them about 2 or 3 of the companies that I had competed with. They hadn't even heard of them. I was like, you haven't even done like, there's no way you should be supposedly building something if you don't know who the current market participants are. So, we all know that competitive analysis is a major component in business, assessment. But if you're going to pitch an idea, if you're going to work on something, if you're going to put your heart and soul into try to get something to defy gravity and get off the ground, do your homework, and particularly to an audience that's knowledgeable.
Yeah. Oh, yeah. What great coaching. That's not just for startups. That's for life, right? Do your homework. Oh, wow, that's great. Please come back to part 2 with Mike Nugent as we go into Mike's view of the technologies out there from a VC perspective. And we'll get into InsurTech and EdTech in the FinTech space. Thank you for listening to What the Heck, FinTech. Make sure you tune into our next episode as we continue to interview FinTech leaders and share real-world stories from across the FinTech ecosystem so you can fully understand that FinTech is Fin Life.